influencing control. So they can be equity shareholding, control on the board, potential voting rights, control agreement, joint control, special purpose entities, de facto control. Economic interest is not the same as control, may not be the same as control. So if there is no control, if we determine there is no control, then look to the relevant specific standards. For example, IC 28 for associates, 31 for JVs. So the other standards would apply. If there is a control, so the deciding factor is control. The control exists, we need to see if that is the case, IFRS 3 would be applicable. Acquisition method is the only method. In this method, we need to identify the acquirer, determine acquisition date, and then account for the rest of the elements. There are excluded items on the left. If you look at the examples, transaction costs, settlement of pre-existing relationships, remuneration for future employment services, reimbursement for paying the acquirer's acquisition cost to issue debt or equity, payment for indemnification assets. So we covered some of them in the presentation, but these would be excluded. Then the next thing, consideration transferred. So the components which form consideration could be assets transferred, liabilities assumed, equity interest issued by acquirer. All consideration is recognized and measured at fair value. Then forms of consideration could be cash, other assets, businesses, subsidiaries, contingent consideration, equity instruments, option warrants, deferred consideration, replacement share awards. Contingent consideration classified as liability or equity. Equity is not remeasured, liability is remeasured through profit and loss. For previously held interest, remeasure a previously held equity interest at its acquisition date fair value, recognize a gain or loss in profit and loss, recycle items from other comprehensive income statement. For NCI, the minority interest, measure NCI either at fair value or at the NCI's proportionate share of the acquiree's identifiable net assets. Measurement choice for each combination, NCI measurement determines goodwill. On the right-hand side, goodwill is a residual. Full or partial goodwill depends on measurement of NCI. In case of bargain purchase, reassess fair values. As I mentioned, that you must recheck the fair values when there is a gain on your previous holdings, and then recognize gain in profit and loss. Identifiable assets and liabilities, they are assumed are recognized if definition of asset liabilities met at the acquisition date and they are part of what was exchanged in the business combination. Identifiable assets liabilities assumed are measured at fair value. Exceptions are contingent liabilities, we discussed that, income taxes, employee benefits, indemnification assets, reacquired rights, share-based payment awards, assets held for disposal. So we discussed most of them. Areas to watch out for: contracts should be reassessed except for insurance and leases. All identifiable intangibles are recognized. Restructuring provisions are rarely recognized. Measurement period within 12 months. Subsequent measurement, reacquired rights, contingent liabilities, indemnification assets, contingent consideration. So these will keep on remeasuring. We will monitor that in future for remeasurement. There is another handout 5, which essentially deals with step acquisition and step disposal. And we discussed that. I'll not go into the detail. You can have a look at a later stage. What it tells us is that when you have an initial holding, let's say 10%, and then it increases to 25%, and then later on it increases to 35%, and then 80%. So how it would be recognized? And if you have, on the other hand, it goes straight to 80% and then 90%, so how would it impact different items? Same is for step disposal, how things would be treated. Okay, so that was IFRS 3. We'll move to IFRS 8. we'll move on to a very interesting IFRS. This is IFRS 8. I must tell you that it has some real gimmick and some action. These are the areas we'll be covering. The basics. There are 4 simple steps which are essential: identification of CODM, identification of operating segments, then determining the reportable segments, and then disclosures. And there are certain other considerations, how this will affect, and then summary. Okay, this IFRS will, in my personal view, will result in various problems for companies, and we should be well prepared for that. It's a new concept. What is the concept? I'll tell you. IFRS 8 is a convergence standard. It follows the American model. In the US, they followed segment reporting not based on the IFRS or GAAP model, but the segment reporting is segments are operating results are reported based on their performance. So if the management assesses their segments based on some weird basis, some profitability, market share, could be many other bases. So if a segment is assessed by management on some other basis, that basis should be used in the segment reporting. And now, because the IFRS is converged, IFRS also recommends, that's the only method we can follow, that we follow the management method. What is, excuse me, the method which management follows to measure the operations of their segments, which could be different from what is under the IFRS. So it's a weird concept. The requirement of this segment reporting standard is that has to be, and there's a presumption that it has to be a strong and reliable MIS. So that is a must. If that is not there, then we are heading for troubles. It would result, this standard would result in varied results. Now, we are only talking about IFRS 8 at the moment. The limited disclosures in the accounts. The accounts are all IFRS compliant. They all have a framework. What does not have a framework is this limited disclosure. This IFRS 8 does not require a framework. So